Friday the 26th, we're an hour away from the opening trade. This is what you need to know. Tariff man is back. President Trump announces new levies on pharmaceuticals, heavy trucks and kitchens. Are semiconductors next? As the US economy appears to re-accelerate, will the massive rate cuts being pushed by the White House actually be needed? We're going to talk about that. And Bloomberg learns that European officials are privately warning Moscow that they are ready to shoot down Russian jets, Val.
Happy Friday. We're starting off this Friday morning with the equity market looking fairly positive, treading water in S&P Futures, but Eurostoxx 50 up 0.4%, seeming to shrug off those tariff threats from Donald Trump for now. But we will be watching European Pharma at the open. The theme of this week, though, when it comes to foreign exchange and interest rates, is that higher yields have been tempting a higher dollar. Both U.S. 10-year Treasury yields and the U.S. dollar are trading around a 3-week high after the back of the strong data yesterday. The countdown to the opening trade starts right now.
$12:10 London time. John Rahm's going to step up. He's going to smash it down the first. The Ryder Cup will be up and running. Donald Trump is going to be there at Bethpage. It's in New York. Home ground advantage. The question is, if the Europeans overcome that and win, are we going to be facing even more tariffs? Trump will not be happy if the Europeans win. We know how that one goes down. We're already starting to see a next round of tariffs coming in, Lizzy. Pharmaceuticals, kitchens, heavy trucks, sofas. This is an eclectic list.
All of our favourite things. He's firing off balls in all directions. Look, let's dive into the Pharma first of all. Unless a company is breaking ground in the US for a manufacturing plant, they're going to face 100% tariffs on these branded or patented goods. Now, we're going to look for an impact on the likes of Novo, shares already down on TradeGate, but maybe the impact isn't going to be as widespread as we're worrying about, because, you know, you've got a lot of players who have announced a bit of investment here and there. They've just got to get that.
It's just unclear. We just don't know the details. That's the problem at the moment.
And the date is next Wednesday, October 1st. This is when these tariffs are meant to be implemented. How are these companies going to be clear whether they get the exemption or not by that time frame?
And what happens to drug pricing in the United States, which is already high versus everywhere else? Does it go up even more? Do the companies eat these tariffs? Who pays this tariff that is going to be applied? The US consumer is not going to be happy if it's them.
You've also got a Wall Street Journal story this morning, Trump considering a plan to cut US reliance on foreign chips. It is a convoluted plan. I don't know if you can make more sense of it than me, but what the Wall Street Journal's reporting is that companies would have to pay tariffs if their customers don't buy as many chips domestically as from abroad. It has to be a 1-to-1 ratio.
One in, one out. So if you sell one in the U.S., you're allowed to import one from abroad. But this is just another tactic, I think, to soften the blunt of what he's trying to do. Instead of slapping tariffs on all of the chip imports, perhaps this is a way for companies to have time to readjust their supply chains. What do you think, Guy?
I don't know. It's also interesting in the light of what has been happening with Intel recently. This is going to help maybe boost their foundry business story as well. Another aspect of that story, which, remember, the US government now has a stake in. Kind of works along those sort of lines. If you have a stake, maybe we're going to kind of try and boost your positioning, which is already happening with NVIDIA and potentially Apple. I think the time factor is interesting here, but there's a national security element to this as well, which they're talking about too. But just taking a sort of bigger picture story here is that the market, I think, is through the idea that tariffs are having an impact. And this is, we take it to PCE, which is going to come out a little bit later on, this idea that tariffs are going to have a limited impact. They're not going to be showing up in the data. But we're still going. We're not done with this narrative yet. So if you can't discount it yet in terms of what we are seeing.
No, it's funny you bring up that connection, because when I read about these new tariffs overnight, in my mind, it's like, well, the GDP data yesterday has clearly shown us that tariffs don't necessarily matter when it comes to hampering economic growth. What a beat for a second revised reading of second quarter GDP, revised up on the back of strong consumer spending, but also strong non-residential investment. So investment outside of the housing market is looking strong. CapEx is expanding outside of AI to other manufacturing. That's what durable goods showed us as well. And then we have to talk about jobless claims. This really goes in the face of what Myron has been arguing, that the
timing was beautiful.
Myron and Waller timing was very beautiful. We had this strong data dropping just after Myron spoke to Bloomberg Surveillance turbulence. But both Myron and Waller are warning that the labor market is flashing red. Jobless claims are at their lowest since June, have really undone the recent rise of the last few weeks. And if you look at continuing claims, that's also turned around as well.
So where is that weakness that Myron is saying you've got to preempt against? And is it really data dependent if you're going to preempt the shock, the impact?
Well, this is what Myron would argue, that instead of the Fed being data dependent, they need to take a view on what's going to happen moving forward. They need to go back to the Greenspan era of forward-looking Fed policy instead of sitting and waiting around for the data. But you have to start arguing that the current data is really, really bucking the trend for what Myron's trying to argue. And the market is clearly offsides on that. We've seen Treasury yields move higher, the dollar go stronger, and the worst week for the equity market in 2 months.
So good news is bad news from an equity market point of view at this point in time. So I think this takes us back to the PCE data, which I think is going to be fascinating. Because in theory, good news is good news if it comes without inflation. But good news is bad news if it comes with inflation. And I think that's the critical thing that we've now got to figure out, is what the inflationary story is going to look like off this. And if inflation is re-accelerating, does the Fed language start to shift in that direction as well? Maybe a more balanced approach being taken. They've been leaning on the labour market, but do you go back to focusing what is happening on the inflation front?
It's also interesting when you put to Myron the stock rally as a case of things are not so weak. He's like, no, that's not because of the expectation of Fed cuts. It's a much broader thing. There are a load of other things that are feeding into it.
Well, stocks are down.
I think that chimes with what Bessent has been arguing, the Treasury Secretary, that the Fed should set policy for Main Street, not to chase the AI theme and cool that down. But it'll be interesting to see with PCE today, because we have been shrugging off this rise in core goods, saying that maybe it's just a one-off tariff factor. It's going to be flipped around towards the end of the year, and perhaps look, that theme, that narrative, is people are going to be really rethinking whether they believe that or not.
It feels like last year, doesn't it? Rate cut and then a rethink.
One and done?
Precisely. You do begin to wonder whether or not that's the case. We were talking yesterday to Mark Cardmore about black swans. Is a European country shooting down a Russian fighter jet a black swan event? We're already talking about it, so it can't be by definition. But you do wonder whether that is the risk that is increasingly growing. Bloomberg has learned that European officials are warning Moscow that is a possibility. I don't know how it would happen. I don't know in what form it could take place. But the potential list of accidents here are enormous. Say a European jet got shot down in combat with a Russian jet over European territory. How would Europe react to that? Would that be an act of war? It would look awfully like it, wouldn't it? There's all kinds of things that could happen. The potential for an accident at this point feels enormous.
Yeah, and you've got the reaction in the market, already. So oil set for its biggest weekly gain in more than 3 months. Gold set for its sixth weekly gain on the overall risk-off mood, but reacting to this as well.
Gold risk-off? I'm not sure these days.
But look, the scope of danger broadening. You talk about where that could happen. Denmark probing maybe whether the Russians were involved in their second drone attack of this week. This isn't just happening in the smaller countries. This is Denmark as well. And then specifically on Ukraine, you've got Chancellor Merz backing this plan for using essentially frozen Russian assets to help Ukraine. So Europe, off the back of UNGA this week, another theme of the week, stepping up more and heeding Trump's call.
And it does seem to be like, yes, Trump is in some way changing his direction on Ukraine and on Russia, but at the same time, he's also kind of hinting that it's Europe's problem. You know, he's not going to directly intervene. Maybe they'll send some weapons, send some money, but it's Europe's issue to solve.
You do wonder whether that could... just to come back to the jets, you get a... do you edge towards an Article 5 event at that point if you were to see combat in the skies over you? I don't know. That looks awfully like it has the potential to generate some very alarming headlines. Let's talk about who we've got coming up on the show. Rafaro Crisieri is going to be joining us, RBC Wealth Management Fixed Income Head in UK and Europe. Winnie Wu, Bank of America Head of Asia Pacific Equity Strategy in London. She's going to be joining us a little bit later. Gerry Fowler, UBS Head of European Equity and Global Derivative Strategy. We are going to talk to him about why volatility is so low and what that is likely to prelude for the rest of the year. Maria Weidmana, State Street Equity Research Head, very front foot on the tech story for a very long time. What does she feel about the AI developments that we've seen this week, Val?
Well, let's take a look at the risk events on the horizon. Today at 9 a.m. UK time, we have the ECB's inflation expectations, a survey. And then at noon, as Guy was alluding to, the golf's Ryder Cup tees off at Bethpage Black over in Nassau County in New York with the U.S. president seemingly will be there today to watch the event. So I don't know how many traders are going to be on their desk for the 1:30 p.m. U.S. PCE data, but it is an important one to watch, the Fed's favored measure of inflation and the one that they target. And then later at 6 p.m. UK, Fed's Bowman, the more dovish-leaning governor, will be speaking. Interesting to see if she has anything to say after the PCE data earlier, or that will have been released earlier.
Nothing really matters after 12:10. John Rahm's going to step up, smash it down the first. DeChambeau and Thomas, though, are their opposite numbers in the full balls. The president's going to be there.
What do you think
this has got to be a risk event,
like,
hasn't
right?
it?
The security, where there's going to be like the U.S. Open, where people couldn't get to their seats in time for the game to begin.
And if Europe wins, who knows? I don't think Trump would be very happy about that. Something of a golf fan. So it's a risk. Anyway, I just think light volume is going to be a feature of the landscape today, and we'll all be watching. Anyway. What else do you need to know this Friday morning? President Trump, talking of which, has signed an executive order which advances plans for American investors to buy TikTok's US operations. The spin-off cuts ByteDance's stake to less than 20%, as required by the national security law. Vice President J.D. Vance says the deal will value the new US company around $14 billion. That is much lower than the previous projections of the valuation being up to $40 billion. Beijing says the US still needs to, quote, provide a fair environment for Chinese investors, though Donald Trump says President Xi Jinping has given the deal the thumbs up.
This is interesting because I had a very good talk with President Xi, and a lot of respect for him. Hopefully he has a lot of respect for me too. And we talked about TikTok and other things, but we talked about TikTok, and he gave us the go-ahead. You know, it's run by American investors and American companies.
In Europe, Volkswagen is temporarily shutting down 2 of its electric vehicle factories in Germany because of weak demand. An electric Audi plant will close for a week in October, while Bloomberg understands that a factory which makes the ID models will close for several days. And looking into the weekend, Moldova heading to the polls Sunday in a parliamentary election that will be decisive for the country's EU accession path. It will serve as a litmus test of the broader struggle between Brussels and Moscow for sway in Central and Eastern Europe. The vote comes amid accusations from Moldova that Russia is trying to tilt the outcome, Lizzy.
Coming up on the programme, we're going to check on those European pharma stocks, especially Novo Nordisk, after President Trump spooked the sector with his newest tariff announcement. Plus, we're going to hear from the NATO Secretary-General, his sit-down with Bloomberg and his view on how to deal with the Russian airspace incursions. But up next, back to markets. We've heard from the Fed's newest member, Stephen Myron, and there's more data to look ahead to today. We'll dive into how the markets are pricing in rate cuts. If you've got any questions of your own for our guests, please do send them to IB plus BBTV Go. This is Bloomberg.
My view is not one of enormous economic pessimism. You know, I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
Trade, taxes, and deregulation allows for significant upside growth without inflation. You can have strong growth and low inflation, and I think we can get the stock market up, Wall Street, Main Street, both doing well.
Fed official Stephen Myron and Treasury Secretary Scott Bessent talking about their view that the U.S. economy can have those rate cuts and we can still have strong growth behind it. But those GDP figures yesterday really past expectations. The GDP figure, this was its third revised reading, was revised up 0.5 percentage point. We normally don't see revisions that large on the third reading, but it was all back down to the revision in consumer spending. Again, another theme guide. Don't doubt the U.S. consumer. They can handle tariffs, and they can handle all these recession calls that we got back in the beginning of the second quarter. Excuse me. And then when it comes to investment, yes, residential investment came in soft, but outside the housing market, investment looks strong. It looks like that AI capex spending is also broadening out to other areas of the manufacturing. That's what the durable goods order for the month of August also showed us. Taking all this in stride, the market has really restarted to rethink where they see the Fed funds rate at the end of 2027. We were pricing in 150 basis points of rate cuts between now and the end of next year. That's gone all the way down to 100. We've taken out 2 rate cuts from the Fed on the back of this strong data and the strong week. The equity market hasn't taken it decently. It is the worst week for the equity market in 2 months, and those U.S. 10-year yields came very close to 420 yesterday, trading at 3-week highs. Today we have the PCE inflation data. That's the Fed's favored measure of inflation. Now, with the backdrop of the U.S. economy perhaps re-accelerating, it's going to make traders think twice about the pickup recently in core goods. Guy?
It's fascinating to see. We're back to maybe thinking about the idea that the U.S. economy is in OK shape. We've seen equity markets backing off. Good news is bad news. Well, as long as we don't get a big pickup in inflation, which could really make it bad news. If we get a big pickup in inflation, it's going to be fascinating to watch. Let's get Rufaro Crisieri's fixed income view of the world right now. She's head of fixed income for the UK and Europe at RBC Wealth Management, amongst other things. Nice to see you. Good morning.
Good morning. Good to see you.
Is the US economy re-accelerating? Should we be pricing out rate cuts?
Well, our view that we've held for quite some time is that the rate cuts that have been priced into the market were too aggressive. We are sort of in agreement with that sort of Fed sort of view of 1 cut, I guess 2 cuts this year and 1 more next year.
Yep.
75 basis points worth of easing. That seems about right to us. And especially when we look at 1-year forward inflation swaps, they're still elevated. So there is still that inflation expectation in the market. And the cut that we got from the Fed was really to deal with the jobs data that was deteriorating. And I know yesterday we got some slightly better data, and it's 1 point, so we're not necessarily going to reshift and say things are rosy once again. But ultimately, it's that inflation story that we think is ultimately going to bring out some of those cuts that are priced in.
How big a rethink do we need to go through in terms of where you think yields are going to be next year in the United States? Let's take the 10-year tenor as being the obvious point to start.
Well, we kind of think the US 10-year fair value is probably closer to 430, 450 region.
Okay.
And so we think there's still quite a bit of room at current levels. Recently, when the 10-year did dip below 4%, we actually lightened up our duration because we thought that trade was had gone too far, and we have started to see that unwind. So we're patient to wait until rates start to readjust to this higher inflation story. And, of course, the fiscal push also coming through in 2026.
Rufaro, we've heard a lot from Fed officials and from economists recently about what AI can do to the neutral rate of interest. Some arguing that it's raising the neutral rate of interest, some arguing that it's lowering it. How do you see this AI boom in investment impacting not only the U.S. economy, but monetary policy off the back of it?
Yeah, I think certainly from the AI perspective, that does improve productivity, and so that does sort of help in that sort of perspective. But I think broadly in terms of when we're sort of thinking where the neutral rate would be, we've actually had the view that neutral rate is probably closer to 325, 350 region. And that's just because of the way that we're seeing the data coming through, growth not necessarily cratering, inflation still seemingly at sort of that sort of upside risks there. So we're certainly seeing that neutral rate is probably higher than what the market's currently pricing in at the moment.
So Fed's Kashkari mentioned that he agrees with you that AI is raising the neutral rate somewhat, all this investment. But he was in some way warning that AI is sucking investment into non-labor intensive industries. So we could perhaps have strong investment, strong growth, but not the pickup in the labor market that would usually entail. Do you see it that way?
I suppose from the labour market perspective, we have that supply sort of constraint at the moment within the labour market where you do have a large chunk of over 55s retiring, and they don't necessarily have skills that are easily replaceable. And we are also seeing higher unemployment in sort of the younger age group, 16 to 25. So I suppose there is some merit to it, but I think with this AI boom, there is so much changing so quickly. And so it's really the data will start to show in terms of how that shifts this sort of dynamic in the labour market.
Let me ask you about these weak gilt auctions that we've had here in the UK this week. How significant are they for you? It's a newer concern, right? We've had yield volatility here. This is new, but it's nowhere near as bad as Japan.
I think certainly for the UK, it's still going to continue to be plagued with that fiscal sort of story. And we have had periods where, I suppose, auctions haven't gone down very well. That was really that sort of 2022 time. And more recently, auctions have actually been going down pretty well. And this week, it's actually just been a bit of a disappointment. Whether that's sort of a taste of what's to come, given that investors are now positioning for what's going to come through in the autumn statement, perhaps that's where some of the pressure is starting to build. But of course, the DMO is issuing debt, sort of skewed to the shorter end, and QT is also skewing away from the long end. So that should continue to support gilt yields.
And so is it, Chancellor Reeves, that you're worried about who's going to keep inflation high? Because you're also worried about inflation here in the UK. You've got PIMCO saying that the slowing wage growth is actually going to bring inflation down and the BOE can cut more than is priced. Is it Reeves that's the trigger for that inflation for you?
I suppose when we I sort of agree with that view in terms of what's happening with wage inflation currently. We have held the view for some time now that wage inflation is going to track lower, and that's really because of that weakening that we're seeing in the labour market, and that should sort of help to bring inflation closer to target. We think ultimately some of the measures that may come out in the fiscal budget, if it's fiscal tightening, that's actually going to be helpful for inflation over the long term. Perhaps in the immediate term with some of the tax rises, it could be inflationary, but then over the long term, since it dampens growth, that should start to bring inflation further down. So we sort of have that view that wage inflation is playing a big part in this inflationary story.
Do you buy gilts right now? What do you think?
I'd say gilt at 475 and up for long-term investors. We think that's a good entry point. We still don't like the ultra-long end part of the curve. Okay. We're positioned 1 to 10 year. And we think for longer-term investors at 475, you have a decent cushion for gilt yields to sort of rise from here without sort of necessarily generating losses.
Rufaro, we had news that Nigel Farage met with Andrew Bailey, the governor of the Bank of England, yesterday, and they discussed, or they debated, rather, whether the Bank of England should be paying interest on money that or the bonds that they're currently sitting on their balance sheet. I mean, perhaps that is a creative way to get out of this debt crunch that the government is sitting on, but that would essentially cause some disruption somewhere in the gilt market and who owns them. Do you have any thoughts on perhaps how they could restructure QT?
I suppose from the current restructuring that they've done with QT so far in terms of shifting it to be 75 billion versus the 100 billion, we think that's pretty much in line with where demand was sort of shifting for the UK debt. It does also mean that there are less sales coming into the market because had they not done that, that would have meant sort of 4 times more sales coming through into the market than previous in terms of this current year. So we think that shift in QT is certainly helpful for the gilt market at this current level.
You've got Farage basically threatening BOE independence, playing out of the Trump playbook.
Feels very familiar, doesn't it?
Right, copy and paste. But at the left end of the spectrum, you've got Starmer's other opponent, Andy Burnham, saying that the government shouldn't be in hock to the bond markets. Remember when we had the yield reaction when Reeves cried and there was the kind of perceived threat to her job? If you ever see any threat to Reeves again, do we just get an absolute huge reaction in the bond market, especially when we're coming into Labour conference?
I think what we previously saw a few months back when I guess there was that little blip in terms of confidence in Reeves, we did see the bond markets react to that negatively because of the view that I suppose Reeves is trying to stick to those fiscal measures. And even though that fiscal headroom is fairly small, but Reeves has convinced the market that bringing down, I guess, that deficit and working on sort of tighter fiscal measures is important because that feeds into the positivity from the bond market. And I think any sort of news around, I guess, any sort of unfunded spending or not tightening enough in terms of revenue coming into the government, that's certainly not going to be positive for gilt.
OK, we'll keep that at the back of our minds as we head to conference this weekend. But Rufaro, really great to have you around the table. We thank you so much. Rufaro Chrysarie, fixed income head for UK and Europe at RBC Wealth Management. Coming up on the programme, we're going to speak to Winnie Wu, the head of Asia-Pacific Equity Strategy at Bank of America. We'll talk to her about China, AI, tariffs and trade. Plenty of news on all of that this week. This is Bloomberg.
Minutes until the start of equity market trading here in Europe. You've got a tariff story that you want to factor in first thing this morning. It looks like pharma stocks are going to be under pressure. Despite that, though, at the moment, it looks like you've got a reasonably positive picture emerging, which is not what I saw first thing this morning. So it's going to be interesting to see how, A, index levels work this morning, and B, what happens on the single stock story, particularly around pharma and trucks, I will mention as well. Don't ignore the heavy trucks.
Let's take a look at how European fixed income is faring in the first half an hour of trade. We have German 10-year yields holding steady at 2.76. Really, the theme this week across European government bonds has been more about the underperformance of the gilt market. German 10-year yields on the week have basically been unchanged. So a lot of the attention more on the UK with that open of the gilt market in 30 minutes' time.
Well, let's turn to the US. President Donald Trump signing an executive order which advances plans for American investors to buy TikTok's US operations. Vice President J.D. Vance says that the deal will value the new US company at around $14 billion. We can get to the view now of Winnie Wu, head of Bank of America's head of Asia Pacific Equity Strategy. Winnie, congratulations on the new role. Great to have you around the desk. I wonder what this news on TikTok signals to you, and whether you're kind of optimistic that the ease of doing business between the US and China is now going to continue in this direction.
Yeah, I mean, I think generally in market feel a bit relieved, right? 5 months after the Liberation Day tariff, it looks like China was the market that came out better than expected. Well, many other markets, many other countries are actually worse than expected in the tariffs or trade war situation. I think people are relieved to see that there are some commercial pragmatism now factored into these negotiations. I think, on trade, China proved its relevance or leverage in terms of the rare earths, critical minerals, so that, the world cannot decouple with China. Not yet, not probably in the foreseeable next couple of years at least. And on these other things, on technology front, both countries are able to sit down and start to work out a solution, which is very constructive for the market.
And so when you speak to European investors, does this thawing of US-China relations make them more comfortable buying into Chinese tech specifically?
Yeah, I mean, I think for emerging market investors, European investors from an equity market perspective, definitely, right? Previously, there's always the fear of Chinese companies become uninvestable, ADR delisting. Even Tencent was put on the U.S. Defense Department list in January this year. So people worry that if some of the technology companies, semiconductor companies, suddenly get on the sanction list and they can't invest in them. But I think with the stabilization of the U.S.-China relationship, it certainly feels China become more a normalized market that people can put a normal valuation on rather than putting a very depressed, big discount on the market valuation.
You've been talking to a lot of investors this week here in Europe. What are they saying? What questions are they asking? What do you think the consensus view is on China and whether to invest in China right now looks like?
Yeah, I mean, I think the sentiment generally is good, right? Emerging market has done well year to date. The European market has done well year to date. So people are generally happy. There's a lot of interest on China. Position-wise, I've known some investors being long-term bear on China. They already cut their underweight and neutral position on China. The long-term bulls are relieved with the China market rally in the past 12, 18 months, and some of them actually added more overweight. In terms of the outlook, when we did a mini survey among the big group lunch, basically 2/3 investors expect China market to continue to do well into the year end. So generally, I think there is a neutral to more positive bias on the China market. In terms of the key hopes that investors have is that there's still a huge amount of domestic household savings, which could go into the equity market, and that might continue the market rally, even multiple re-rating. And with the equity market rally, the positive wealth effect is that going to finally help with the depressed consumption and drive up inflation. That's the big hope.
Your view on that hope is?
We would be a bit more cautious on that, because when retail investors get in, they typically do not play the ETFs or the boring high-yield SOEs, right? They like to chase the mini stocks, right? The stocks that go up 20% in a day. But by the time retail investors chase, especially if they take leverage, margin financing, to chase these mini stocks, the risk is they will end up lose money rather than make money. I mean, even for our professional investors, many of them feel this year is not easy, right? Overall markets up, but in terms of outperformance, in terms of pair trade, it's not easy market.
And it's been, I guess, a rally that many have been reluctant to buy into.
Yeah.
But Winnie, I wanted to ask you about, in terms of catalysts that you think the market is discounting too much. Yeah. What do you think is not on traders' radar that should be?
I think currently the key catalyst market are looking up to is in October in China. There will be the fourth plenary session, and together with that will be the 15th five-year plan. So investors are looking to get some clarity on what's China looking at next 5 years growth target on GDP. Next 5 years, will there be more emphasis on domestic consumption, and what are the policy measures around that? And if there's any structural reforms, for example, to address like the local government leverage issue, to address the overcapacity, subsidy, repetitive investment. So that's a key thing, and market generally tend to be more constructive heading into this big political event, right? People want to hope there's positive catalyst coming through. And then the second thing people are looking at is the potential President Trump and President Xi meeting at end of October. Again, whether there's further progress on these TikTok deals, U.S.-China deals, or further improvement in the relationship on the two countries.
Do you think the market's underestimating a possibility of Trump and Xi announcing some kind of tech partnership?
Tech partnership, it's certainly not in the price. I think when people think about the deals, it's probably more on the buy-sell deals, on the soybeans, on the aircraft, and maybe some looking at how China can help with some of the geopolitical tension around this part of the world, right? But I do agree that, on tech collaboration, people are remaining to be very skeptical, especially given U.S. recently put even more companies onto some sort of sanction list.
And NVIDIA, and they hit back at least on NVIDIA's ability to sell chips into China.
Yeah, and meanwhile, China is also investigating into NVIDIA in terms of whether there's any security concerns, and is kind of advising its own tech companies of buying local.
What does anti-involution mean, and what is happening with the overcapacity story?
Yeah. So this time they use the word of anti-involution, not only supply-side reform, which means reducing supply and production is only part of the story, but there's also a focusing on bringing in local governments' repetitive investment, subsidies, and build a more unified national market. So we could potentially see some redistribution of power between central and local government over the next 5 years, right? It's not going to be easy, but it might be a direction in terms of more centralized government planning to coordinate the local government investment activities. And also there's an element of protecting the supply chain SMEs. So when, for example, in the EV industry, they were telling some of the large EV companies, say, hey, you can't extract your account payable cycle for over 200 days, right? You got to pay your component suppliers, and you can't put all the inventory burden on your auto dealers. So there's also this social common prosperity, protecting SME element. For the supply reduction itself, so far we saw bits and pieces target in specific areas, but certainly it hasn't been a grand planning with very clear target and milestones. And I think so far central government is more focusing on market-driven mechanism, more like a moral persuasion to say, hey, you different industry groups, associations need to work together to address the issue, which means the progress will probably be relatively slow and like to see immediate turnaround in the deflation situation.
But what about on the demand side? When you're comparing US AI and Chinese AI as something to invest in, how much can Chinese AI depend on the domestic market? How willing is the Chinese consumer to pay for this?
Yeah. I think U.S. and China AI are playing out differently, you're right. I mean, if you look at U.S. AI, it did drive Magnificent Seven's earnings. It did drive the GDP. But those are mainly from the CapEx investment side, right? Whether it's investment in the chips or investment in electricity, data center. But in many of these areas, China have sufficient supply, or to some extent oversupply in the data center in electricity already. So there's less need for China to do a lot of infrastructure investment to support the data center. But for China, I think the really interesting story for AI will be when AI can create new user scenario and more domestic services related jobs along that. If you think about mobile internet, it actually created many jobs, right? The Uber jobs, the online education, the online influencer, the TikTok jobs, those didn't exist before mobile internet, right? So even technology displays jobs. We are hoping AI can also bring new user scenario, new jobs. And that will be hopefully the big turnaround for China's economy, because currently in the economy, fundamentally, what's missing is the confidence on jobs, on income. And I think pure government subsidy is insufficient to really turn around people's expectation on jobs. But new technology might be.
Winnie, I just want to ask you about something you just mentioned there about data centers in China, mentioning that they seem ahead on data centers versus the U.S., maybe versus the West. Is that another reason to be bullish China AI, is that they don't have to do this investment cycle? I guess the revolution of having that computing power is already there in China?
For computing power, of course, the chip remains to be a bottleneck, right? But in terms of the other infrastructure, in terms of electricity supply, right? Our reporting early this month said, the international institutions estimate is that by 2030, global AI data centers electricity consumption will be 950 TWh. Right, which will be bigger than Japan, a country's full year electricity consumption. So that's a huge number. And from U.S. perspective, they worry that the U.S. Energy Department worry that the blackout hour will increase by 100 times by 2030 because of the electricity consumption from AI. But for China, in the month of July, China consumed and generated 1,000 TWh. Right? So in 1 month, China already generated what Japan consumed the whole year. So you can say that China has overcapacity in many areas, but to some extent, it's also strategic overbuilt in the electricity, in the infrastructure.
No, that's pretty interesting. That just the bottleneck is just their progress on chips, but they have the computing power.
Well, no, they have the electricity, they have the electrons to be able to do it in a way. The US has got 50-odd something nuclear power plants, right? China's built huge numbers of nuclear power plants and has all kinds of hydroelectric and all kinds of other resources available to it, and it's going big on the renewable side of things. It has the electrons, just doesn't have the chips. The US doesn't have the electrons.
But how quickly could all of that really escalate once they do, if they do, make a breakthrough on producing those 3 nanometer chips? It's really interesting.
Comes down to lithography.
Yeah, Winnie Wu, thank you for joining us. The Bank of America head of Asia Pacific Equity Strategy. Well, coming up on the show, we'll be watching European pharma stocks after Donald Trump unveils a 100% tariff on the sector. We'll talk about that and your other stocks to watch next. This is Bloomberg.
European diplomats are said to have warned the Kremlin this week that NATO is ready to respond to further violations of its airspace with full force. NATO Secretary-General Mark Rutte spoke with Bloomberg's editor-in-chief John Micklethwaite about NATO's resolve to defend its airspace.
We're still assessing whether the drones in Poland and the fighter jets in Estonia, whether it was intentional. We don't know yet. Still being assessed. Of course, with Copenhagen, with Denmark, I spoke with the Prime Minister this morning. There we are also still assessing who was behind this. Also very worrying what happened there, obviously, and we're all working on that. But when it comes to these fighter jets, that's not new. It's bad. It should stop. But our pilots know what to do, and if necessary, they can do the ultimate.
There's a difference, though, isn't there? Russian, with the fighter jets, there seems to be quite a clear policy, as you've said, that's been for years. Russian jets should not come into NATO airspace. The drones is much more complicated because there tend to be lots of them. They're hard to defend against it. And there you seem to have a kind of, there's the intentionality problem that you pointed out. Is this on purpose? Isn't it? But another big one is just having the kit to deal with them.
Exactly.
Because, as I understand it, what would happen at the moment is you might have to use a very expensive missile to shoot down a very cheap drone. Is there a kind of kit problem with this as well?
In the short term, yes. And by the way, I was very proud of the Dutch fighter pilot last week who took down, or 2 weeks ago now, who took down these drones in Poland, F-35 pilot. And it's exactly what we need to do, because first of all, we have to prioritize the safety of our people. Yes. But you're right, it is not sustainable that you would take down $1,000 or $2,000 costing drones with missiles which cost you maybe $500,000 or $1 million. So this is why our Supreme Allied Commander in Europe, together with the colleague working on transformation, all of us in NATO are rapidly developing the technologies, learning from the Ukrainians, and we will start to apply that new technology over the coming weeks and months to make sure that next to the more traditional way to deal with this, we also have this drone interceptor technology at our hands.
The NATO Secretary-General speaking to Bloomberg's editor-in-chief. The conversation talking about what is happening on the fringes of Europe at the moment, or what is happening in terms of the geopolitical risk. Our pilots know what to do. The ultimate is possible. That is what the message is from the NATO Secretary-General. That's a risk you've got to price into the European equity picture this morning, which at the moment actually looks fairly positive, which is really interesting considering the risks that are growing around A, the geopolitics, and B, the tariff narrative, which once again is front and centre this morning. Pharmaceuticals, heavy trucks, sofas, kitchen cabinets, all of these apparently on the list. Joining us now to discuss how this is going to be factored in is Bloomberg's Moena Cunningham. Good morning.
Morning.
How do we factor this in? It looks like pharmaceutical stocks are going to be under a little bit of pressure this morning, but European equities broadly look like they're on the front foot.
Absolutely. Futures are up across the board actually now, and that's perhaps surprising because we've had these big tariff announcements. If you look back to April when we had announcements like this, it weighed on equities very heavily. But I think there are two factors happening here. One is that this has happened before. We've seen that the impact wasn't ever quite what it had initially been perhaps perceived as. There's the whole sort of Trump always chickens out trade. But also this is quite nuanced. And actually there is this caveat for particularly for pharmaceutical manufacturers, which is if they're building manufacturing facilities in the US, then there are no tariffs. And that is something which some of the companies are already doing. If you look at like AstraZeneca, they already have a quite large manufacturing base in the US, and they also announced more plans in July. So a lot of the companies have sort of got ahead of this in anticipation. I think the Swiss pharmaceutical companies are the most exposed. Also, the Novo Nordisk is actually, most of that's made in Denmark, the Ozempic drugs, and that's a real problem, I think, perhaps there. Okay. But again, some of this has been priced in already, and we're coming from a period where stocks have been weighed on, and actually there was a bit of a sort of aversion from risk earlier this week already. So I think we're coming from a very different place than we were in April.
Rowena, what is gold telling us? Is China buying? What are these ETF flows telling us?
Yeah, so gold, we're about to complete the 6th weekly gain in a row. We've been at record highs. We've been up 40% this year. I think the question really is how much further do we go from here? There are some signs of slowing. Some of those fundamentals that have been driving it, such as aversion to the dollar. Yesterday we saw better than expected GDP. That's not so good for gold from the US. But we also see what the inflation data today brings to that. But in the long term, all of the reasons why these haven assets, and particular gold, have been so appealing are all still on play. And I think today's tariff announcement just underlines the case for fundamental uncertainty that's driving gold's appeal. And we're still seeing those flows, and we're still seeing central banks buying.
Just finally, Moena, I'm heading up to Liverpool tomorrow for Labour Party conference. How much are the bond vigilantes lingering over that this week?
Yeah, I think it's really going to be in focus, particularly after what we saw yesterday from Andy Burnham, really telling the government to sort of stop being and hock to the bond market, at the same time calling for more borrowing, which of course is one of the problems for the bond market, and traders are not going to like pledges for further spending. I think a key catalyst is actually going to be Reeve's speech on Monday. If she seems to be leaning towards the left, or whether she's talking about maybe hinting at raising taxes, that could alleviate some of the pressure. But really, we're looking ahead towards the actual budget itself, I think, for any real relief there for gilt yields.
All right, Bloomberg's Moena Cunningham, thanks for your thoughts on the market. Now, with less than 8 minutes to go to the start of European equity trade, let's get our stocks to watch with Chloe Melly. Chloe?
Good morning, Valerie, and happy Friday. Perhaps not so much of a happy Friday for European pharmaceutical companies. Trump has announced a breathtaking expansion of tariff coverage on that sector with a 100% tariff rate on branded pharmaceuticals. There is one exception, one caveat, which is that if those companies are building manufacturing facilities in the US, then they will be exempt. A lot of those companies have announced those types of investments, but not all of them have broken ground on those promises. The entire sector could be moving today, but I've singled out Novo Nordisk because it makes the key ingredient for Ozempic and Wegovy in Denmark, and Novartis as well, because it makes a lot of its top-selling drugs in Switzerland. So, of course, the entirety of that sector could be on the move today. Moving on to Germany, and we're taking a look at Volkswagen, which has cut output and paused production at some of its manufacturing plants that make electric vehicles in Germany. Volkswagen shares were actually up yesterday because of the new data around growing sales and growing demand for EVs in Europe. But the pace of that growth has been slower and more uneven than anticipated, and Volkswagen is also dealing with excess capacity. So let's see how the stock moves today. And finally, let's end on hotels, and IHG was double upgraded to an overweight rating at JP Morgan that mentioned good earnings visibility and good free cash flow. It's actually been underperforming its peer Whitbread, as we can see here, so we'll see how that changes the picture. And of course, IHG is also not necessarily an analyst darling. It has a majority of holds and sells, only 6 buys, but this new vote of confidence, this new upgrade could be a step in the right direction for that company.
OK, Chloe Melly with our stocks to watch. We thank you so much for that. We're looking at futures pointing higher on both sides of the Atlantic. Tariffs? What tariffs, you might ask, at this point?
Well, I think we're going to see it maybe priced into some of the pharmaceutical stocks this morning. That could be an area that you're going to watch. Let's see what the big truck companies do on this morning. It is nuanced, but we don't understand the nuance, and that's the problem here. So what do you do with some of these stories? Is it the Swiss names? Is it some of the Danish names that could come under pressure? We are about to find out. 5 minutes to go until the equity market open. Futures are pointing higher, though. The open is next. This is Bloomberg. Friday morning, bit of volatility in yesterday's session. Wow, the data was interesting, wasn't it? The US economy feels like it's re-accelerating. The employment picture looks a lot better post those claims data that we saw yesterday as well. Do we need rate cuts? Do we need the kind of rate cuts that we've been talking about over the last few weeks? Is good news bad news? Well, that was certainly the narrative that we saw evidence yesterday in the US, though we did rally towards the end of the day. Europe went out kind of here. We rallied kind of back towards those kinds of levels. So it's going to be interesting to see how that trades through into Europe this morning. But at the moment, European futures, Val, look fairly positive.
Look fairly positive and outperforming their U.S. counterparts. Eurostoxx 50 futures solidly in the green this morning, up 0.5%. We do have our eye on Switzerland after Trump announced more tariffs on Pharma. So SMI is in the green, but underperforming the broader picture here. DAX futures also in the green, up 0.4%. Lizzy?
That takes me to the stocks to watch, Val. In terms of Pharma, keep your eye on the likes of Novo Nordisk. This policy is nuanced. We await the details of it, and we don't know really who is going to be the most affected, who has got their spades already in the ground before October the 1st. Novo down on Tradegate. Will we see broad selling across Pharma because of the caution around this tariff policy? Then there's chips. The Wall Street Journal story this morning that Donald Trump's planning to cut US reliance on foreign chips. So watch the chip sector. Trucks as well, looking for higher tariffs. And we mentioned VW specifically cutting output. Do we see specifically VW shares harmed this morning, Guy?
4 hours, 10 minutes until the Ryder Cup starts in New York. We're looking forward to that. In the meantime, we've got the European equity market open that we need to be thinking about. So here we go. Let's show you some numbers. Let's talk about the impact on Pharma, on trucks, what is going to be happening in the chip space. All of that needs to be factored in. The early read is we're going to see a positive picture emerging. How nuanced will that be? Let's find out. FTSE 100, nothing to see here yet. Let's move on and talk about what else we're going to see in the other markets. How is AstraZeneca going to be trading in London? How is Roche, Novartis, how are they going to be trading on the SMI in Zurich this morning? The stock 600 broadly positive. We're expecting around, let's call it circa 0.5% out of Europe this morning. But it's going to be interesting interesting to see what the breakdown looks like in terms of the single sector stories. What's Germany going to be doing this morning? You've got the defence narrative you need to fold in there as well. Plus, you've also got the industrial story when it comes to the truck story. What is going to be happening with Daimler Trucks, etc., all these kind of big businesses, which could be affected by what Trump is doing at the moment. The CAC is up by 0.3%, a little bit of outperformance coming through there. The IBEX is up by 0.2%. It's had an interesting week, hasn't it? With names like Henderson Moritz impacting what is happening with Inditex. Let's talk about some of the single names. Val, what have you got in terms of the sector story?
Look, in terms of the sector story, it is a clear picture. We have most in the green, except for technology, except for healthcare. The healthcare industry, or the healthcare sector, shall I say, is down 0.5%. We're still waiting for some of those healthcare names to open, but Novo Nordisk down 2% at the moment. We also have technology at the bottom of the basket. Remember, there was some reporting about semiconductor tariffs coming out of the Trump administration. So it does seem to be that these warnings on tariffs are hitting specific sectors when it comes to Europe. But as a whole, European stocks are higher this morning. We have 435 in the green, only 120 in the red at the moment.
Yeah, Novartis not hit as badly as Novo. So Novartis only down 0.5%, Novo down 1.9%. We're still waiting for Daimler Truck when we look to the impact of the tariff story there. And as you say, when you look across the chip sector, all in the red, really. ASML, 0.7%. Infineon, the most, 1.4%, but it's tech hit again by that.
It's interesting, Volvo's up. So Volvo, one of the biggest manufacturers of trucks in the world, is actually rallying this morning. It's up by nearly 2% on the back of this tariff narrative. We don't understand the nuance, the detail around some of this tariff story that we've had overnight. The White House still not providing it for us, but it does seem as if Volvo is tacking higher this morning. But the biggest losses clearly are coming through into some of these pharmaceuticals names. That's where we're seeing the real weight being added to the downside. Novo is off by nearly 2%. What is interesting is that Astra, a company that has made big investments into the United States, that only just recently announced even more investments into the United States, is also being marked down. That's a big weight on the FTSE 100. Bayer is down. GSK is also tracking lower as well. Some of the mining names are softer, but the story really is in what is happening with this pharmaceutical story, which has been so interesting to watch over the last few weeks and months in terms of the way that investors are positioned around that space. But again, just a spanner being thrown in the works by the Trump administration and just having a huge impact and a really fast one. And it feels indiscriminate this morning. And that's the problem. We don't know the details of what is happening here.
Yeah, a lot of details still to be worked out. But the thing is that these tariffs that were floated by President Trump are due to be implemented next Wednesday. So there's not a lot of time to get that clarity. But we do have Daimler Trucks continuing to fall in the red, now down over 4%. But as you mentioned, Volvo, who also makes those heavy cars that will be under those tariffs, is in the green. So a bit of a different picture, at least when it comes to the trucking industry, but a clear picture when it comes to pharma and technology this morning. Joining us around the table to discuss these tariffs and more is Gerry Fowler, the UBS head of European equity and global derivative strategy. Gerry, thank you for joining us this morning. Does the U.S. economy need the rate cuts that are currently priced in?
Well, we don't know yet. I mean, the data looks like, especially the upward revisions to Q2, that there was some pull forward. In Q3, it looks like some of the activity might be slower. Our economists are certainly tracking current activity as weaker, not stronger. But then equally within the surveys, the new orders seem to be picking up again for the future. What is definitely clear is that the jobs growth has slowed to probably below a neutral rate of jobs growth despite the immigration changes. But there's a really big question as to whether that's cyclical, as in, the economy is actually slowing, or maybe part of the productivity story, that companies are actually able to generate more revenue without needing to hire people.
If the U.S. economy is re-accelerating and looking strong into the end of the year, does that change your view on any European stocks that you follow or any sectors?
It probably helps the story that the euro will be less of a headwind for European equities, because to the extent that the US economy is weak, the Fed is cutting rates, the dollar declines, there's more diversification away from that US trade into other markets, you would end up seeing the euro strengthen perhaps a little bit more than we would have thought. Now, we've had a lot already, which is why Europe has been lackluster. Half of the market have been heavily impacted by this 15% move in the currency. Our expectation is it only goes, say, another 5% further over the next 6 to 12 months. But it may not go any further if the US economy is actually resilient. You'll have a pretty nice, healthy global growth environment, and you won't have that strong headwind of the euro rising if the US economy is still attracting plenty of capital.
Why is volatility so low? And if it remains as low as it is, do stocks continue to move higher?
It's a good question. So it depends where you look, because actually single stock volatility, particularly during earnings season, is actually alarmingly high. Lots of really big stocks moving 10, 20%. I think something like 15% of the S&P 500 moved 10% or more on their earnings day in the last season. But they're going in different directions, some up, some down. So the index looks like it's not very volatile. What that does also is just brings in more sellers of volatility at the index level. But as volatility gets compressed, that brings in more buyers of the market, the CTA and risk targeting strategies. So everything's kind of feeding on itself at the moment, that because these policies are driving divergences in stocks, you get actually a less risky overall market that attracts more leverage into it. So it's a bit of a compounding effect at the moment.
How quickly could that reverse?
Well, I mean, it depends on the catalyst. So if you have minor changes to that dynamic, maybe the correlation is a little bit higher, you know, and you start getting a little bit of an increase in volatility that disrupts some of these flows, then, you know, it could reverse steadily through time. Of course, if there's a really big catalyst that we just can't foresee, then it'll be a much bigger, you know, correlation one move. But in comparison to things like COVID or the housing crisis in 2007, it's not easy to foresee one of those things that could really blow things up anytime soon.
We've been debating all week whether this is a bubble or the new normal, whether the bigger risk is staying in or staying out. I mean, does the pause that we've seen slightly this week in the rally give you pause?
Not a great deal. So, first of all, are we in a bubble? The answer is not yet, because valuations can be justified by the scale of earnings and the earnings revisions, the constant revisions that we're seeing. Like, it's an expensive market, but it's not outrageously expensive for earnings that continue to both grow and get revised up. The bubble will be when earnings are no longer either growing or being revised up, and yet the valuation is still going higher, you know, late 1999 style. And, you know, that may come, but we're not there yet. Andrew Garthwaite, our global equity strategist, thinks that all of the conditions are now in place that we will end up in a bubble, but we're not there yet. So, you know, it's hard to sort of determine, you know, what exactly to do here. In the very short term, the market feels a little bit like it's run a little bit far. Lots of the companies that have been supporting the market through their buybacks are on pause because we're waiting for that second quarter earnings season. The earnings upgrades have slowed because you tend to get the upgrades post-results, and we've had those a month or two ago, and we're awaiting the next results. So we're just in that usual quarter-end window where buybacks stop, the upgrades stop, and there's a little bit of confusion as we wait for results.
And in the meantime, do you see it broadening out? Do you like the small caps?
So we do, pretty much in every market, particularly Europe, because they're obviously more domestically oriented. That's a pretty well-known story. But even in the US, I think there's plenty of arguments for a broadening out. The main one is that it is possible that AI diffusion may support US small caps before it supports global companies, because they're much closer to that AI nexus. What I'm looking at is sales per employee. Sales per employee for large companies, especially tech companies, has been constantly rising because they just continue to be more productive, but it's been flat for small caps. There's just a hint that US small caps in particular might be becoming more productive, generating more sales per employee.
Isn't that, doesn't that lie a problem, though? Because, yes, maybe these AI companies are getting more productive, but they're not needing more workers off the back of that. Mm-hmm. How do you picture that?
Well, so basically it gives you a sharp split between the benefits to capital providers versus labour providers, which is usually very good for the capital providers for a while, but the reality is the economy is only what people can consume. And if you don't have enough people with enough money to consume, you end up with a problem. But there's a window there before, you know, we get the dystopian, the AI dystopia.
Doesn't the stock market solve that problem in as much as the upper echelons are spending lots of money because they believe that their assets will continue to inflate and therefore they can continue to spend money?
Correct. There is a bit of a problem in how narrow the US economy has gone. Aaron Captain, our chief economist, was highlighting to me yesterday that part of what makes the US look more productive is actually just a narrowing of the activity into only the AI data center capex. Nothing else is apparently improving, and a narrowing of consumption into very wealthy people. You know, nobody else is seeing consumption improve. So you've got this huge narrowing to, you know, a few very rich companies and a few very rich people that is, reasonably unhealthy in the long term, but for the moment makes the equity market look pretty compelling.
In terms of
it's a conundrum.
I'm wondering how this ultimately gets resolved and what we need to see. We are at very elevated multiples at the moment. There is an awful lot of money going into the AI trade. It seems that if you are a company that announces big investment plans, you get a big bump in terms of your stock price performance. Is this... When do we need to see results, I guess is the question, on the AI trade in order to give us confidence that it is going to actually pay for itself, that the revenue is going to be there? David Einhorn's out this morning, one of the top-read stories on the Bloomberg terminal. Everybody's talking about it. It's echoing similar sentiments we've seen from people over the last few days and weeks. Show me the money. Where is the revenue? You have to make the revenue, and it's unclear at this point. So this is a very speculative bet at this point.
So it feels a lot like 2022, really, when you went through a downgrade cycle for NASDAQ company earnings. They actually were revising lower their growth and profit estimates because they had let costs get out of control. At the time, it was their labour costs and post-COVID, too much hiring without the revenue to back it up post-COVID after that surge. So you got some weakness. Now, it wasn't significant and it wasn't all that long, but a year or two of consolidation. So that could definitely happen because the scale of spending we're seeing in AI does seem very large compared to the short-term revenue opportunity for quite a few of those companies. But it's just going to be interesting to see whether that's a slow grind adjustments and calibration and perhaps impacts those large companies a little bit, and whether that is partnered with...
Is that what history tells us? Because history doesn't tell us that generally, actually, these kind of big investment booms kind of consolidate.
Well, it is true. It depends on how quickly that capacity is being utilised. I suspect with AI being much easier to diffuse than the last tech bubble in 1999, it may well get the infrastructure may get utilised very quickly.
But it does seem to be that at least looking at past infrastructure build-outs, someone is going to get over-leveraged in this
a lot
AI
of this is coming from
supply
debt, isn't
chain.
it?
And who is that going to be? Where is it going to sit? I mean, when I think about the risks, at least Europe is kind of shielded from any AI bubble bursting because the AI trade isn't really in Europe
it's about
right
to
now.
get going.
Is that your opinion?
Well, absolutely, because one of the key tenets of the Draghi report and the general European resilience and security agenda is to create its own technology centre, and Europe is going to need its own data centres that are managed by European companies because they don't want to rely on, cables that can be cut or foreign companies that, can have variable politics.
It's been a year since the Draghi report.
Yeah. Well, but it's getting there. It's getting there. Actually, there was a report recently that 12% of the recommendations have been implemented, another 25 are partially implemented, etc. But the sector that might actually benefit most, which no one's really watching, is telecoms, because for a lot of this digitalisation, and when you think about data centre creation, the telecoms may end up being quite a sort of hidden beneficiary of a lot of this stimulus in the security space.
It's fascinating. The key difference to my mind in what is happening with this AI build-out versus what happened in 2000, up to 2000, when we had this big cable build-out. Once you put a cable in the ground, you might not use it next week, next year, even in 5 years' time, but it's there. With a data centre, you build a chip, you put a chip in, that chip's got a life cycle of 3 years, 5 years, and then it's kind of...
replacement.
You need a replacement for it. So the fibre build-out had longevity. We're still using the fibres that we put in sort of 97, 98, 99.
Yeah, and speaking to the telecom trade, one of the main reasons to buy telecoms in Europe is that actually they spent so much money building 5G and fibre over the last 20 years, huge amounts of capex, that they weren't generating a huge amount of free cash flow or growth. So they've been an absolute dog. No one's wanted to buy them for 20 years. Now they're actually investing less. They need to invest less in 5G, less in broadband, because they're basically done, which means they're expanding their free cash flow. They've got lots of money, and actually that makes them very compelling because finally they are not a capex-intensive sector at the moment. Reduction in capex.
Just like what Winnie Wee was saying about Chinese power.
Yeah, they've already got the power. They don't need the electrons. They just need the chips, which is interesting. Gerry, great to see you as always.
You too,
Thank you very much indeed. Gerry Fowler, UBS, Head of European Equity and Global Derivative Strategy. Core 6 looks like this morning. There's some interesting trades out there. There's some real divergence in some of the trades that we're watching, both in the pharmaceutical space and also in the heavy truck space this morning, which is absolutely fascinating. Novo is, though, soft off the back of the news we've had out from Donald Trump overnight. The chip space is also a little softer as well. Keep an eye on a journal piece that is floating around this morning relating to what happens next on the chip front. It is down. But elsewhere, you're seeing maybe some of the more defensive names. Nestle hasn't been that defensive of late, but it is popping higher this morning by around 0.5%. What else are we watching? Let's take you back to the pharma space and Chloe Melly.
Good morning, guys. So, yeah, as expected, a lot of weakness in that pharmaceutical space on the back of that 100% tariff rate on branded pharmaceuticals that Trump has announced overnight. So we can see a lot of weakness, particularly for Novo Nordisk, that makes its main ingredient for Ozempic in Denmark. We also see, interestingly, some weakness for AstraZeneca, even though it is one of the companies that is building manufacturing facilities in the US, which Trump said would make those companies exempt from those tariffs. So we see quite a lot of weakness, although quite modest moves so far. Moving on to the chip sector, and there we also see a little bit of weakness across those names: Infineon, ASM, STMicro and ASML, on the back of a report from the Wall Street Journal that the US is looking to dramatically decrease its over-reliance on semiconductors made abroad in order to boost that production domestically. So that is driving down those shares across that semiconductor, that chip-making sector this morning. Moving on to another Trump-related story, and we have got a little bit of a divergence here in terms of stories with the truck-making space. So Trump announced a 25% tariff on big trucks, and that is dragging down Daimler Truck and Stratton. But Volvo is actually up. It actually owns a company in the US, a US truck manufacturer called Mack Truck. So it might be why it is also up. It might be the reason why it is there. But we also await more details on those policies, which are supposed to be in place from next week. So as the market digests this, that might explain the divergence in that performance. And finally, let's end with IHG, the hotel operator, and it is up this morning on the back of that double upgrade by JP Morgan that mentioned good earnings visibility and good free cash flow. And that is really driving the stock. It is up 2.5% this morning for IHG.
Okay, Chloe Melly from our equities team, we thank you so much with those movers. 16 minutes into the open. And next up, we're going to dive into those pharma tariffs. 100% tariffs announced by Donald Trump. We'll have more next. This is Bloomberg. So, President Donald Trump's announced a fresh round of tariffs targeting a broad range of sectors. It includes a 100% duty on branded or patented pharmaceuticals. That starts October the 1st. And he's also announced plans to impose levies on heavy trucks, kitchen cabinets and upholstered furniture. But as you can see, the mixed reaction in heavy truck stocks this morning. Volvo up, Daimler down nearly 2.9%. Well, let's get some more detail, shall we, with Bloomberg's Jill Desis. Jill, we need detail here. What more do we know about these tariffs?
Well, Lizzie, unfortunately, when it comes to where we stand with these right now, we know about as much as Trump put out in that social media post, which is, of course, just, the value of these tariffs. I mean, you mentioned the ones on heavy trucks for 25%. We've also got some kitchen and, sort of kitchenware, furnishings, that kind of thing. So this is all what he's announced, as well as, obviously, those drug tariffs, 100% levies he's talking about that are due to go into effect next Wednesday. I think, though, the really important thing to note with this is that a lot of this seems to come out of these ongoing commerce investigations. So the Commerce Department, under the Trump administration, they've been spending months trying to slap these levies under the Section 232 rule. I think this is a bit different and actually might be more difficult to legally challenge than, say, those country-by-country tariffs that Trump also announced as part of his big Liberation Day plan. So what we've seen under these latest tariffs, this is the same type of sectoral process that he's used to advance levies on aluminum, steel, automobiles, auto parts, that kind of thing. So, we stand right there now, but I think we're waiting for the U.S. to wake up so that we can get a few more details on what exactly this is going to look like.
Yeah, with these tariffs set to come into force next Wednesday, I think probably the clarity on the pharma sector is most important. I saw Bloomberg News writing that if you take all of pharma included in this 100% tariff, it would move up the average tariff rate by 3.3 percentage points. Do we know how these tariffs are going to be implemented?
Yeah, I mean, that's a huge question, right? Because the big caveat with that pharma tariff, I think, is the fact that Trump said that as long as you're breaking ground or, putting under construction some kind of massive U.S. manufacturing plant to manufacture drugs in the United States, then maybe you wouldn't be affected. I mean, I look at the big drug makers like AstraZeneca, Johnson & Johnson, Merck. I mean, these are all companies that have been kind of, expecting something to come on the pharma sector this year, right? I mean, the Commerce Department has been investigating this, but particular sector for quite a few months now. And so a lot of these guys have made, pledges worth potentially, billions of US dollars in the type of manufacturing. But it kind of comes up to Trump and how exactly this is worded as to whether or not that's enough to satisfy the requirement to be exempted from this. The other thing, too, is how this plays into existing tariff agreements, right? The U.S. and the EU reached an agreement earlier this summer to impose only 15% tariffs on pharmaceuticals. Is that overridden by this? I think that's the other open question here, too. So a lot still unanswered, and the deadline really, as we've mentioned, is coming up next Wednesday.
Jill, great stuff. Thank you very much indeed. Jill Desis joining us on this story. Let's get another view on what is happening in here. Let's bring in Sam Fazeli, Senior Pharmaceuticals Analyst for Bloomberg Intelligence. Sam, Jill raises loads of questions that we don't have answers to this morning. We don't know what manufacturing in the States and the impact that will have, what actually counts, what happens to existing trade agreements, what goes on there with Europe in particular. What is your early read of what we're looking at here?
Yeah, Guy, nice to see you again. You helped me. We got 6 lines of truth, right? So how am I going to be able to get anything out of that? There's so many questions that the commentators just before me raised, which are critical here. As long as you have a shovel in the ground, you're okay. But does that shovel have to be for a manufacturing facility that's related to a specific drug? What if they are building a facility, which most pharma companies are doing, and of course, they already have facilities there. And they've all started a variety of pledges. What if they're building a facility for drug X, but drug Y is still coming from, Ireland or Switzerland or Denmark? Well, how does this relate? If I've got one manufacturing facility being built, am I exempt? And also, 100%, clearly, it's just impractical. You can't do that overnight because that immediately raises prices in the US, which of course you can't do. It just doesn't make any sense. So as a method to try and get pharmaceuticals to continue to see through with their pledges, this probably is the best thing that the president, or the key thing the president's after.
So while we wait for detail from the White House, Sam, what do we know about the companies who have got shovels in the ground? Because I'm looking at the stock reaction this morning. You've got Astra down, but Chloe Melly telling us earlier that they're already building. Have you a sense of who's going to be more impacted than other companies?
Yeah, no, it's very hard to tell. Of course, the Novo Nordisk was mentioned there because the volume of drug required for obesity is so massive that and a lot of these obesity companies, the 2 obesity companies, were caught a little bit unprepared with the supply, with the demand level that came in. So they're all trying to catch up. Of course, they've caught up a little bit. But AstraZeneca, I think pretty much they've said over and over again that the vast majority of drug that they sell in the US is manufactured in the US. Most pharma companies have done that. The ones who haven't are building. And I'm pretty sure Novo Nordisk is in the process of putting manufacturing together there too. The question is, what is enough to satisfy the president so that these tariffs don't come in? I fully expect that on the 1st of October, nothing will happen. Most of these companies will highlight to the administration what they're doing, and the president can get the deserved win that he's got. He is forcing these companies to move manufacturing.
OK. Maybe not as much of a reaction as we're seeing in Novo shares this morning then. Bloomberg Intelligence, Sam Fazeli, we thank you so much for that analysis. Coming up on the programme, hedge fund manager David Einhorn is sounding the alarm on AI spending. We're going to discuss that with a Bull Bear panel coming up next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session here in Europe, and is looking fairly positive across the board. European equities are continuing their outperformance versus U.S. equities this week. The U.S. equity market is actually having its worst week in 2 months, but European equities are keeping their shine, especially today. Euro Stoxx 600 up 0.4%. Some outperformance in France. Those shares up 0.8%, and some underperformance in the FTSE 100, just up 0.2%. Guy, how's it looking under the hood?
Let's take a look at what we're seeing. As you say, front foot, 434 stocks up, 151 down. Volume's a little light. It's going to get lighter as the Ryder Cup kicks off a little bit later on this afternoon. Are we taking the afternoon off? going to park that one for the moment. 52-week highs, Babcock, Repsol, ING on my list this morning. It's interesting to see Repsol on that list once again. It's up by another 0.9%. I want to turn our attention, though, to what is happening with the 52-week lows. There's a story here that really stands out. There's three that I've highlighted, but there's one that really stands out, and that's Cucinelli. We'll come back to that in a moment. Teleperformance is down. Diageo is trading down by 0.7%. But here's Bruno Cucinelli. Morpheus, which is a recently formed short seller, announcing yesterday that it's taking a position here. Let me just show you the two-day chart, because the news came out yesterday afternoon, and you can see that the drop we saw yesterday, back end of the session yesterday, was really big on the back of this news. It has continued today. I think there might almost be I think there's a volatility halt right now. Was last time I checked as I walked away from my desk. The stock has been absolutely smashed on a two-day basis and is now down by nearly 25%, a quarter of the value of Bruno Cucinelli being wiped out in the last 24 hours, and we are only just getting the second session underway. So that's the narrative we're watching this morning. Not so much quiet luxury this morning when it comes to the luxury space. What are we watching, Lizzie, when it comes to the other things we need to know this morning?
Well, if you're just joining us, we've got plenty of news when it comes to the tariff front. US President Donald Trump announcing a 100% duty on branded or patented pharmaceuticals, as well as new levies targeting heavy trucks, kitchen cabinets and bathroom vanities as well. The new tariffs are set to start on Wednesday, and other duties on critical imports, including semiconductors and critical minerals, are expected in the coming weeks. Elsewhere, Bloomberg has learned that European diplomats have warned the Kremlin that they will shoot down Russian jets. This, as the head of NATO tells Bloomberg the alliance can't afford to down drones with expensive missiles. Russian Ambassador Alexei Meshkov says that, quote, if NATO shoots down a Russian plane under the pretext of an alleged violation of its airspace, this will be war. And finally, former French President Nicolas Sarkozy has been handed a 5-year jail term in a corruption trial. Sarkozy was found guilty of criminal conspiracy over allegations that aides and political allies covertly sought funding from the Gaddafi regime before his election in 2007. So, Guy, it feels a little bit naughty, is the news on that. We've got ID cards back in the UK and Sarkozy on the front of the papers.
Absolutely. That ID card announcement is going to be fascinating a little bit later on. Big step forward for the UK, you could argue, or a big step for the UK. I just want to come back to this Cucinelli story. I just say that Bloomberg is out to Cucinelli for comments. I just want to make that point clear. Anything that involves one of these big research reports, short-selling research reports, we need to just make sure that we're covering all of our bases on that front. So we'll come back when we get news on that front as well. Let's talk a little bit about what is happening in the tech space, because that is fairly interesting as well. The hedge fund manager, the famous hedge fund manager David Einhorn, is sounding the alarm on AI spending, warning that it may destroy vast amounts of capital, even if the technology itself ultimately proves transformative. The Greenlight Capital founder says the trillion-dollar build-out by companies is so extreme that investors may not see the payoffs they are anticipating. He adds that, quote, I am sure it's not zero, but there's a reasonable chance that a tremendous amount of capital destruction is going to come through this cycle. That sounds eerily familiar for some of the other comments that we've been having from fairly well-known names in the tech space. Where do we go from here, then? Are we in a bubble? Is it going to burst? Are we going to see vast quantities of capital being incinerated here? How do you trade it? Do you get on board? Where in this bubble could ultimately be? And do you view China and the US differently? Let's try and answer some of these questions. Maria Weitmana, equity research head at State Street Global Markets, long-time tech bull, joins us, as does Robert Lee, senior analyst at Bloomberg Intelligence. Robert, I'm going to start with you. We have had a number of very large announcements over the last few days from companies talking about investing trillions of dollars over the foreseeable future in data centers, in AI. It does seem we're at the position now where the more you announce in terms of your spending plans, the higher your stock goes. What do you make of this? Where are we in this narrative?
OK, well, absolutely, in a China context, that's completely true. Stocks here are trading at premium multiples. We're seeing stocks going up 10, 20, 30% a day based on headlines, based on hype and based on hope. But it's not really underpinned by the fundamentals. So just to quote a quick number at you, Alibaba, which has been one of the top performing tech stocks here in the China context, their capex more or close to trebled over the last 4 quarters, yet their cloud intelligence profit increased by only 86 million. So, sorry, what I didn't quote at you there is their capex went up to 5.4 billion. So I would say that's a pretty poor return on investment.
Let's bring in Maria Weitmana. Maria, I assume you're still positive on tech. If that's not the case, please let me know. But if there's anything that will change your view, I'm sure you test your thesis on the tech, on the AI trade every morning when you walk in. Is there a red flag that you're maybe watching for in this market?
Yeah, hello. I'm absolutely still very, very bullish on tech sector. I mean, to me, tech sector is pretty much at the moment, a lot of optimism about tech is that there is really no alternative. So tech sector is a sector with the strongest cash flow, strongest earnings growth, highest margins. Yes, it is trading at high multiples. Yes, investors cheer everything. But I think mostly because there is so much cash in the economy, so much liquidity, and there is no other place for it to go. There is no other sector, no other kind of region where we see such a strong earnings growth, such strong cash flow. So investors funneling money in. And I hate to say it, and similar to previous panelists, is that we see very little alternative. Where else money would go? And fundamentals matter less and less. So investors putting this liquidity into sectors that grows, and it's tech, and they keep investing.
But Maria, does the quote-unquote vendor financing that we've been seeing between NVIDIA and OpenAI, Intel asking Apple for funding, not worry you that this is them propping up the market, that this resembles bubbles previously?
Yeah, I mean, it's hard to kind of argue with that. Vendor financing is a red flag, but I mean, they do have cash. They have a lot of cash. So they're investing, and what they're doing is that they're building moats around their business. They're making it really, really hard for anyone to enter the space and compete it away. And I think this tech kind of enthusiasm will continue until we get somewhere else to put the money in. And so far, there is nowhere.
But, Rob, we look at many of these businesses. Yes, they've got cash. Not all of them do. It's interesting to look at Oracle's debt load and what it is saying to us at the moment about where we go here. But, Rob, if you look at what is being talked about now, and we had Bruce Richards from Marathon earlier on this week just talking about the amount of debt that is going to be required. So, yes, some of this is going to be funded by the balance sheet, but a lot of it is going to be funded by debt. And once you start to get into go down a road where debt is so high and the leverage is massive, isn't even the slightest miss going to produce risks?
Well, yeah, that's true. But conversely, a lot of the large tech platforms, particularly in the US and China, are really awash with cash at the moment. They're highly cash generative. So even though they're investing, substantial or humongous amounts of capex, in the near term, they can afford it. But I mean, if this thing really is truly a bubble, and I think there are a number of incredibly worrying parallels with the dot-com boom, which is a period of my career I did work through, because the monetization is not coming through. So if ultimately that leads to a substantial level of value destruction, then not only is that potentially going to hit the equities, but as you've just lined out, that's going to also impact on the debt side. But can I very quickly come back to something that Maria mentioned? I mean, I have every sympathy and understanding for active fund managers. As she said, if you're not investing in tech, paraphrasing her, what else do you invest in? I completely understand that. But in a China context, there is a huge disparity between the performance of these techs and what's happening on the fundamentals, because the earnings, the monetization is not coming through. In fact, in cash terms, they're heavily loss-making. So, ultimately, in my view, it's fundamentals that drive stocks in the long term. Liquidity, short-term trading, that's one thing. That's what's driving markets in the moment. But this detachment between the stock price performance and the fundamentals on the ground should really worry people, I think.
Maria, I want to bring this to you because I think that's a good point. How long can this market wait until we see a boom in productivity gains? How are you viewing that? And is that something that's really informing your thesis on how far to take this tech trade?
Yeah, no. I mean, I very much agree with Robert in general that fundamentals matter. And for now, it's tech that's growing fastest, and it's tech sector that's kind of generating most profits. So it's... I mean, it's not completely irrational that institutional investors, particularly in the US, are putting their money into the sector. But in terms of productivity gains, actually, I mean, it's interesting. So the most productivity gains, I think, from AI are still attributed to tech sector. So they're the ones who are kind of managing to get some return on that investment within the technology sector. So they getting more efficient, and I guess that's one of the use cases, and they're benefiting from it. But I mean, the whole world is very intrigued. We still see capex in the sector. We still see transfer of money from non-tech into tech. So that is happening. Investment is happening. Similar to investors, I guess CEOs are kind of, there is fear of missing out is still there, so that they feel like they need to be part of this technology build-out. We're uncertain. I mean, nobody knows where this technology is going to be, but people wary of missing on it. As cost of inference is coming down, kind of spread of this kind of investment into AI continues. And that helps support profits in large tech companies. Competition is very little, so the margins are still very, very healthy there, and that supports their performance, I guess.
Rob, how much can we attribute this rally to the president himself? He's Intel's pitch man. I wonder who's going to be next after NVIDIA and Apple, if Apple comes through as well.
Yeah, absolutely. I mean, sentiment.
Sorry, Rob.
Yeah. Okay, sorry about that.
And then we'll come to you, Maria.
Yeah, I mean, he's the best friend of a short-term momentum trader, isn't he? But again, as I mentioned a moment ago, it's fundamentals that ultimately drive tech stocks. So, for example, if you just take a step back, who's benefiting at the moment? Because clearly some companies in the ecosystem are. This is NVIDIA and anybody involved on the infrastructure side. But ultimately, their end customers, the users of these services, need to be developing tools and so-called killer apps that are ultimately going to turn a profit and justify these very large amounts that they're spending on cloud. And I think across the board, globally, not just in China, but the US as well, we're not really seeing these killer AI apps. So at the moment, we're in a phase where if you're an infrastructure provider, you know, these are boom times. But ultimately, if your end customers who you're supplying those services through are not making a profit or have got no prospect of making a profit, then, you know, again, that is something that I think people should be focused on. And just don't forget, very briefly, the MIT survey we saw a month ago. I think on the back of that, 5% of companies they surveyed were making a headway financially on AI, and 95% were not. So the evidence is there.
Maria, let me just pick up on that last point. The MIT survey was interesting. There are other surveys out there as well. How long should the market wait for the revenue that ultimately AI needs to produce? We need to pay for this service, and I'm not talking about the revenue that NVIDIA is generating at the moment, the kind of the end-user revenue. How long do we have to wait for that to be there? How long do you think the market is going to have patience with this trade? Because the revenue at some point does need to be there, but we're miles away from it now.
Yeah, I mean, new technology is developing, so it's kind of uncertain. But I think I want to pick up on this MIT survey, and obviously 95% not making profit is like very catchy headlines. But actually, if you read closely through the survey, I mean, what survey said is that the technologies that was AI technologies that was implemented properly for what it's intended for, solving specific problems, is very, very productivity enhancing and doing what it should be doing. And surveys with like smaller firms that kind of focus on it do really, really well using AI, and technology is transformative. It's not very clear how you, like, the broader use cases are not that found, but solving specific problems is doing a fantastic job in increasing productivity. And I think we need to, as an industry, we need to spend more time developing those kind of focused applications, what AI is very good at. It's not generative AI, it's not going to replace us, it's not going to all of a sudden, I mean, produce TV anchors and strategists, I hope. But if you have specific problem, particularly like data classification, finding information, kind of connecting the databases, that does a fantastic job and enhances productivity very well. So I think we have to have reasonable expectations, set correct tasks, and AI is very useful in those in those applications, and that's what market needs to focus on.
Yeah. Maria, when it comes to where you're most bullish, where you're most positive on the AI supply chain, where is it? Is it more in the infrastructure build-out names, or is it more in those who have specific use cases for AI, like Palantir, for example?
I think you're exactly right. Market is very excited about infrastructure. I mean, the tech infrastructure. I mean, those stocks trade at huge premium, but they seem to have kind of insatiable demand that massively outstrips supply. So for them, the profitability looks very clear for a few years forward. That's really exciting for investors. They need certainty of earnings, so that's where a lot of money going to for. But next step is absolutely what you said: the specific use cases. Where we can see the benefits of AI. So those two, I mean, they're kind of tried and tested, and they continue to receive inflow. I think market is a little bit more hesitant on kind of pie-in-the-sky applications, but where there are specific cases, like, I mean, first of all, infrastructure, and secondly, like solving specific problems, those companies are very much rewarded.
All right, the bull versus the bear, the hopeful versus the cynical. Maria, thank you so much. Maria Bateman, Equity Research Head at State Street Global Markets, and Robert Lee, Senior Analyst at Bloomberg Intelligence. Great to have you both with us. Now, staying with tech, and stepping back a little, Apple has long led Silicon Valley in tech, but in the world of AI, it's falling way behind, and continued missteps could threaten the iPhone's dominance. Bloomberg Originals has been looking at what went wrong and if Apple can catch up.
Siri, what's the name of the guy I had a meeting with a couple of months ago at Cafe Grinnell?
You met Zach Wingate at Cafe Grinnell.
Zach!
Actor Bella Ramsey was bailed out by a new version of Apple's Siri that was meant to be available for all.
That feature still has not been released. It's originally supposed to come out April, May of 2025, but now it's on track for spring 2026.
Apple took down the ad and is facing a lawsuit over the delay. But the disconnect exposed a deeper issue. The company was losing ground in the AI race.
They totally missed the boat. There was indecision. There was lack of concern that this could become a real thing.
This is a story about how hard it can be to stay on top.
AI is something that wasn't in their DNA.
Continued failure doesn't just hurt Siri. It could threaten the iPhone's dominance. The product line accounts for more than half of Apple's revenue. So missteps with what's become its most noticeable missing features could be devastating.
We saw this for many decades. Nokia was at the very top of the phone industry. Apple came out with a much better mousetrap. BlackBerry was at the top of the industry. Apple came out with a better mousetrap. They are going to be in danger of the next Apple being created if they don't get their act together soon with some serious acquisitions, changes, and partnerships.
Subscribers could watch that documentary right now on the terminal and at Bloomberg.com, as well as on the Bloomberg Originals YouTube channel tomorrow.
I really missed my BlackBerry. It was amazing.
Keys.
One of the best pieces of kit I've ever had. Distant memories. Coming up, UK Prime Minister Keir Starmer announces plans to launch a digital ID scheme. We're going to explain what it is and what it's going to mean. That's next. This is Bloomberg. Things to watch out for the rest of the day. The UK Prime Minister, Keir Starmer, is going to try and relaunch his administration with a speech a little later today. This, of course, comes ahead of the Labour Party conference, which is taking place in Liverpool this weekend. He is going to announce a plan for compulsory digital ID cards to help combat illegal migration. Just give us some data on what is happening as well in the UK. That would be a useful, maybe, derivative of this. Joining us now for more on this announcement and the flurry of press stories that we're seeing in the UK at the moment, circling at the Prime Minister ahead of the Liverpool conference, is Bloomberg's Alex Wickham. Good morning. Good morning. How significant a step is this for the UK to go down an ID card route?
It's really interesting. It's something that Britain hasn't wanted to do for decades. You know, 3 decades ago, Tony Blair was talking about doing this as Prime Minister. He never managed to get it to happen. He wanted physical ID cards back in the day. Now Keir Starmer has sort of reprised this idea in the new context that Britain has an illegal immigration crisis. And one way of helping to combat that is to try to keep track of who's in the country and ultimately, when people go to employers and say, you know, I want a job.
How quickly does this happen?
Very good question. The government won't tell us, which you know, opens a lot of doubt into it immediately, which, you know, government IT programmes are hardly known for their sort of speed and competence.
And security.
Indeed. So there are loads of issues, and that is why the Conservatives, Reform, the Liberal Democrats are all coming out this morning and saying we don't like this. So it is a rare thing, relatively rare thing sometimes in British politics, where there is a clear dividing lines. And, you know, Starmer has really got to make the case here. He's saying, you know, come on, this is my sort of progressive but also tough way of dealing with this problem of illegal immigration. I think he's got a lot of convincing to do to get people to back it.
So that's Starmer's latest thing on how he's going to try and save himself. He's languishing in the polls. Two of his opponents, you've got Nigel Farage talking about the Bank of England needing to lower rates, meeting with the BOE governor. Then you've got Andy Burnham saying that the government shouldn't be, what was his quote, in hock to the bond markets. I've heard that before from someone else. How seriously should the market be taking the threat from those two men to the Prime Minister?
I would say, and I think markets are being sort of calm about this. There are several years until a general election. Andy Burnham, for example, as a potential Labour rival to Keir Starmer, he's not even an MP yet. That's a requirement of being Prime Minister. So there are several steps before Andy Burnham could become Prime Minister. Political journalists obviously love the gossip and intrigue and potential of political infighting in a government or a Labour Party. But markets obviously know that there are several steps that are going to need to happen before that is even a remotely realistic possibility. Farage, again, you know, it is a credible threat, of course he is, to Keir Starmer. At the next general election, absolutely, you know, he is challenging. There is a major poll out this morning that puts Farage on course for a majority, which is extraordinary.
Wow.
But we are still several years out, so in terms of immediate risk, I think it's relatively limited.
Yeah, look, because when I drive around the country, I go home to Manchester, I see the flags everywhere, and I wonder whether we're underestimating the threat of Farage, like the UK media did.
But we're
Brexit.
miles away from an election.
Sure, but I wonder what the mechanism is. Is it that you see a coalition with the Conservatives and that Farage gets the infrastructure of the Conservative Party that they don't already have?
I think for Farage, he wants a majority, and it's an extraordinary even to be talking about that, but it's not completely implausible. And, you know, I think that the reality is the Conservatives, after 14 years, ultimately failed in their project and were resoundingly rejected by voters at the last election. You know, it's going to take a long time for voters to want to vote for Tory again and trust the Tories again. The problem, I think, for the mainstream parties is if Labour, who have been given their turn by the public, also fail to do the things that the public wants, whether it's fix the cost of living, NHS, immigration, all of these things, what are voters going to do other than look to Nigel Farage? He is the obvious person to look to next. And that is the kind of, you know, extraordinary thing that is happening in British politics at the moment. And that is really why you see things like flags go up and down the country. You know, as Farage always likes to say, something is happening out there. You know, we will see, but there is something happening.
All right. Bloomberg's UK political editor, Alex Wickham. Great to have you on the desk.
Busy weekend coming up for Alex and Lizzy. They're both heading up to Liverpool, I assume. Looking forward to the coverage of that. We cast our eyes to the other side of the Atlantic, the Ryder Cup. 12:10, I think John Rahm, Spain's John Rahm, is going to tee off.
And the U.S. president will be in attendance. Nassau County, Bethpage Black. It's going to be a good battle.
Oasis, is it the final one tonight? No, tomorrow night.
I don't know.
In London. Women's Rugby World Cup final. There's lots of great sport coming up this weekend. Have a fantastic weekend, everybody. All eyes on Liverpool. This is Bloomberg.